Holy moly, this market is a complete disaster. And it's also quite interesting because the yield curve is, quite frankly, steepening very strongly. We have only inverted for about 36 hours back on April 1st, and ever since then, the market, well, since the inversion, has essentially been going kind of straight down. It's kind of interesting if you actually look back and think about it. It was essentially right when the yield curve inverted that's it. That was the beginning of the slide. Whee! Straight down. It's been kind of crazy. Since, though, that yield curve is inverted, we are now at the steepest level of the yield curve that we have been at since about the middle of February, since about February 17th. We're at a spread of about 49 basis points, which ordinarily would signal, hey, if we only had an inversion for a day, how could we have a recession? But, interestingly, the argument is that, oh, don't worry, the recession's already here. And so the yield curve is just like, nope, well, if we're going to have a recession, got to quickly invert and let everyone know. Anyway, at the same time, we've got break-even inflation rates dropping still, which these should be good signals, right? A steepening yield curve should signal a strong economy and not a recession. A declining break-even on the 5-year Treasury or even the shorter-term Treasuries should indicate to us less runaway inflation or more anchored inflation expectations. Right now, those levels are down again. We're at now levels of inflation expectations around February 28th. Obviously still elevated, but rotating down. Just like used car prices are rotating down, freight prices and shipping prices are also indicating signs of rotations down. You've got, though, unfortunately, the 10-year Treasury yield sitting now at about 3.13%, and yields just across the board rising. There's really no way to go to safety. You've got emerging markets that are getting hit, value stocks are getting hit, you've got bonds that are just getting decimated, and the expectation is now that we broke 3% and have kind of gone from 3% on the 10-year to now 3.13, that, oh my gosh, maybe we don't need to cap out around those 2018 levels. This is actually something that we've been talking about on the channel, that I don't actually think 2018 is going to be any kind of resistance point for Treasury yields because we didn't have inflation back then. Now we do. So to me, it just wouldn't be a surprise to see the 10-year Treasury yield rise to something like, I don't know, 3.5%. Now, do I think we're going to see a 4 handle on the 3.5 Treasury? Who knows? I have absolutely no idea, but I think 3.5% is entirely reasonable. After that, hey, maybe the market can get a little bit more excessive. The markets tend to do that, right? We go excessive to extremes in either direction, whether that's excessive to extremes in the positive direction or to the negative direction. So what do we have right now? Well, we've got a futures market that indicates the Dow is going to open up down 1.1%, the S&P down 1.53%, NASDAQ down roughly 2%, actually now 2.02%. At the same time, we've also got a little bit of a fall in oil right now. You've got oil actually rotating down slightly, about 2.5%, both on WTI and Brent. Now, this also then, of course, brings up what happened with Putin and Victory Day. Remember, that's what I talked about yesterday, was when you wake up, see what happened with Putin and Victory Day. And so, of course, as scheduled, Putin Day occurred. As we suspected, Putin called his denazification of Ukraine a special military operation. And remember, these are some of the largest troop losses sustained since military operations in 2014 in the Donbas region when the existing Ukrainian government was overthrown in 2014 again. Now, this parade is the most watched parade in Ukraine. Sorry, not in Ukraine. Probably definitely not in Ukraine. In Russia. And Putin didn't really give us any kind of guidance on what was to come next. Instead, he gave brief justifications, suggesting that without providing evidence that the United States or the West, potentially just referring to Ukraine here, but implying in addition to Western countries, maybe just with Western help, were preparing for the invasion of our land, including Crimea. There were multiple hacks as well at the same time as this broadcast was going on, and Putin was suggesting these things, including one hack that took control of smart TVs in Russia and then changed the name or the title of every program to, quote, and it was sort of like a scrolling name because the name was a lot larger. To imagine how when you're scrolling through the channels, it might say like BBC, right, or Fox News or whatever. Well, that title was changed to, quote, "On your hands is the blood of thousands of Ukrainians and their hundreds of murdered children. TV and authorities are lying. No to war. Now, Russia was also planning an air display, but that was canceled due to weather reasons, they say. And they had been training these air defenses or sort of signals of air superiority strength over the last few days, but that wasn't possible for their show yesterday, again, apparently due to weather. Again, NATO was referenced as a, quote, obvious threat to Russia, and ultimately, quote, urged Europe to find a fair compromise. And at the same time as you've got this, you had Zelensky, who released a video saying, we won on Victory Day. We won. We will win now, too. And this is him sort of referring to the past, but then also kind of sending an innuendo today that, no, we've got this in the bag, too. And that will have a parade of victory as well, but that victory will come to Ukraine, and we will not give up any bit of Ukraine or any land. This is, of course, where folks are like, oh no, does this actually mean things got worse, not better, right? Because we, maybe about a month ago, we're in this position where, hey, maybe this war will be over by May. Ukrainian officials mentioned by May, by Victory Day. We had, I've sort of been expecting by the end of May, but now, here we are 2.5 months in, and no real talks here on compromise of, oh yeah, okay, let's carve out certain areas as a buffer zone, or demilitarize maybe the Donbass and figure out how we can operate these neutrally and provide assurances that Ukraine won't join NATO. These things were talked about, now just aren't coming up as much anymore, so potentially leading to some of the red that we're seeing in the morning today. But in addition to that, you've got kind of this really interesting shift happening at companies. But the question is, are these companies that are really companies that we need to worry about? Like, for example, you've got Robinhood laying off 9% of its workforce. You've got Facebook freezing hiring. And at the same time, Uber has now released a letter. After earnings, the CEO writes, I spent several days meeting investors in New York and Boston, and it's clear the market is experiencing a, quote, seismic shift, and we need to react accordingly, he says. My meetings were super clarifying, and I wanted to share some thoughts with all of you. As you read them, please bear in mind that while investors don't run the company, they do own the company, and they've entrusted us with running it well. We get to set the strategy and make decisions, but we need to do so in a way that ultimately serves our shareholders and their long-term interests. So this is very interesting. Here you have a CEO going, hey, just a heads up, our bosses are saying we gotta clean up ship a little bit here, so be prepared for what's next. Sounded like the guy from Family Guy. Anyway, in times of uncertainty, investors look for safety. They recognize that we are the scaled leader in our categories, but they don't know how much that's worth. Channeling Jerry Maguire, we need to show them the money. We have made a ton of progress in terms of profitability, setting a target of $5 billion in adjusted EBITDA for 2024. But the goalposts have changed. It's now all about free cash flow. Remember, this is something we talked about last week as well. If you're in a profitless company or a money-losing company, probably get out, right? And get into profitable companies, because that's just been the trend over the last 4 months here. There will be companies that put their heads in the sand and are slow to pivot. The truth is that many of them will not survive. So now we're talking about the potential forecasting of business bankruptcies coming in this sort of next wave here, unless, of course, you adapt. Uber CEO here talks about how the average employee at Uber is barely 30, which means you've spent your career in a long and unprecedented bull run. I love it when the old folks are like, oh, you don't know. The next period will be different and will require a different approach. Rest assured, we're not going to put our heads in the sand. We will meet the moment. Oh, here we go. Number 2, investors finally understand that we are a completely different animal than Lyft, Slam, or other ride-sharing platforms. They're incredibly excited about the pace of our innovation. Yeah, how much more could you innovate Uber? But all right, whatever. Huge growth opportunities like hailables and taxi. Okay, I think he's talking about auto taxis, robo-taxis, right? And they acknowledge that we are winning. Okay. Yet they don't know the size of the prize. Their questions run the gamut of, has anyone other than you made money in on-demand transport. 2, ride-sharing has been around for a while. Why isn't anyone else profitable? And they see how big the total addressable market is and just don't understand how this translates into significant profits and free cash flow. We have to show them. It's really interesting. You really got the Uber execs here. I think they really believe that, oh, don't worry, we're the best. Tesla's robo-taxis have no chance. Anyway, we'll keep going. Investors are happy with deliveries growth coming out of the pandemic and see we have performed better than most other pandemic winners. I must admit, and I was a bit surprised because I firmly believe delivery should be growing even faster. The primary questions were, is delivery a good business and why? I mean, honestly, if these are the questions the executive of Uber is getting, quote, is delivery a good business and why? He's talking to some morons. Like, who asks these stupid questions? But anyway, like, have you not read a single one of our earnings reports? Right. Anyway, their delivery's doing quite well. In fact, that's why they have so much more driver retention than Lyft. At least that was sort of what we analyzed last week in the earnings call. So I guess it's surprising to me that some of these questions seem so bland. Anyway, so talking about what happens if we enter a recession. Okay, this gets more interesting, right? And so this is where he then goes into talking about investors who asked about freight love freight. However, less than 10% of them asked about it. Freight needs to get even bigger so that investors recognize its value and love it as much as I do. Number 5, meeting the moment means making trade-offs. Ooh, here come the trade-offs. The hurdle rate for our investments has gotten higher, and that means some initiatives that require substantial capital will be slowed. In other words, probably bonuses. We will have to make sure that our unit economics work before we go big. The least efficient marketing and incentive spend will be pulled back. Ooh, pulling back on marketing spend. That's not great. We don't like to hear that. We will treat hiring as a privilege and will be deliberate about where and when we add headcount. We will be even more hardcore about costs across the board. Number 6, we have started to demonstrate the power of the platform, which is a structural advantage that sets us apart. As you know, our strategy here is simple. Bring in consumers either on mobility or delivery, encourage them to try another, and tie everything together with a compelling membership program. The advantage here is obvious, but we have to show the value of our platform in real-term dollars. All right, so kind of interesting. Talking a little bit about maybe paring back on marketing, talking about paring back on hiring or really being deliberate if they do hire someone. This follows Robinhood cutting. This follows Meta sort of freezing jobs, right? So we got to think about that. And then the last thing the Uber execs here say is we have to do all of the above while continuing to deliver an outstanding and differentiated experience for consumers and earners. Whether someone is booking rides for a summer trip with friends or a new parent relying on Uber Eats for everything from groceries to dinner and diapers, it's on us to make sure the experience is excellent. The same goes for anyone who comes to Uber to earn. We responded to the pandemic by becoming an earner-centric company, essentially. We're innovating for earners, literally, blah, 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 whatever. Okay, whatever. So, that's a letter to employees yesterday that obviously was like instantly leaked to the media, and it really signals this sort of malaise of, oh no, we have to, batten down the hatches and be a little less spendy and frothy. And this makes sense, right? This is sort of what you would expect if you're in a recession or going into a recession. Now, for me, what I think is fascinating about this is generally you see the most hiring cuts or job loss when you're already in a recession. So if we start seeing other companies start saying, oh no, maybe we too need to start cutting and removing people from positions because we're overpaying or whatever, maybe that's an indicator that you're actually starting to see more evidence that no, the recession is now. Now, who knows? We'll see what happens going into the Q2 GDP report, especially since, we've now broken low levels and levels that we've been bouncing off previously on QQQ and SPY. And so this creates a lot of fear. And so then the question becomes, how many layoffs do we potentially see? And does it just reiterate the fact that maybe we're already in the depths of that recession? Now, my thesis as to why the market is reacting as horribly as it is, that we're about to have this full candle break on the day chart on QQQ below the 0% fib, is really because we're not getting great news from the big catalyst that we were expecting at the beginning of this month. Think about the catalyst that we've had so far. We had a jobs report that reiterated the Federal Reserve can continue to hike. When the Federal Reserve came out with their Federal Reserve FOMC meeting, we didn't hear, hey, we're going to do 150 basis point hike and then go back to 25. No, we heard we're going to do 3 50 basis point hikes, which may as well have been a 50, a 75, and then a succession of a 50, a 75, yeah, and then a succession of 25s, right? You may as well have had that. Now, we did have a little bit of hopium this weekend that the Federal Reserve was suggesting, hey, well, you know, we've already tightened quite a bit. We don't necessarily have to get extremely more aggressive here. Problem is, nobody really believes the Federal Reserve right now, right? When we get catalysts that come and go and the market gets worse, you get this almost self-fulfilling dynamic that the direction we're going is down. Why? Because the Fed's behind the curve and they're failing and they can't be trusted. They've lost that credibility of trust that when the Fed actually makes a statement over the weekend, now we've already tightened a lot. Like we're on the right track now. People don't believe it. And so probably the strong jobs report combined with not believing the Fed is a very strong catalyst for suggesting this market should be red. Beyond that, Victory Day, to some extent, was a little bit of a nothing burger. You kind of ended up with a Victory Day that gave us no clarity in terms of Putin's intentions to potentially scale back his operation. But on top of that, folks, what do we have in 2 days? CPI numbers. And most investors, in my opinion, are not looking at the CPI numbers going, oh yeah, they're going to, you know, the estimates for CPI are substantially lower and that this Wednesday could actually mark the beginning of a turning point in inflation, which ultimately leads to the Federal Reserve likely taking a dovish U-turn at some point in the future, which anytime the Fed takes a dovish U-turn, that's usually your signal to be like, okay, time to go all in, right? That hasn't happened yet. You know, they've kind of suggested that they're getting ready for a dovish U-turn, but they haven't actually made that dovish U-turn yet. And but what's the market doing right now? Nope. Don't believe it. Don't believe the CPI lie. So, I mean, we'll see. But this Wednesday will obviously be very big with core CPI expected to sit at 0.4% month over month and headline CPI month over month expected to be 0.2%. These are going to be some of the lowest numbers that we've had in at least 6 to 8 months. So quite wild. Probably looking back to that time frame when we had a low inflation in the summer of 2021 before, of course, all of this disaster really took off. Anyway, that's probably why, at least in my opinion, the market's selling off, along with the fact that we're breaking that upper bound on the 10-year Treasury. So welcome to pain.